One of the most common questions, David, what happens if the economy collapses in my retirement? Am I going to be okay? Am I going to have enough money? And it's a great question and a very important question to ask, because the reality is a market crash is inevitable, right? It's not will it crash, it's when will it crash and how severe will it be and how badly will you be impacted, because the reality is a stock market crash can absolutely destroy your savings, your investments, and ability to stay retired. But if you're mindful with thoughtful planning and just even a simple approach, you can actually reduce the risk quite substantially. So what this risk is called the sequence of return risk. Take two people. We've got person A and person B. Both of them have the same amount of money, the exact same investment strategy, as well as they're withdrawing at the exact same rate. Exact same scenarios. But they could have very different outcomes in a market crisis. So person A retires 2 years earlier in a strong economy, an upmarket. Person B retires 2 years later in a down market, so a bad economy. And everything else remaining the same, person B could actually run out of money twice as fast as person A. That's what it is. It's effectively, if the market collapses, what are the chances of you running out of money? If you take $1 million and you're withdrawing 4% a year, $40,000 a year for bills, and you're an aggressive investor and the stock market collapses, well, your $1 million is now worth, let's call it $500,000. But your bills don't go away. Bills don't care about the economy, the administration, geopolitical, or how healthy things are. Bills have to get paid, and you still need the $40,000. So then you withdraw 8% a year while the market is down, selling assets at a loss. And that could make it really tough or even impossible sometimes to recover, therefore running the risk of running out of money. Now, if you're within 5 years to retirement or your first 5 years in retirement, this is actually the riskiest part of your retirement. It's called the retirement risk zone, and that's where the sequence of return risk is most prominent. That's the riskiest time of your financial life in retirement. So the question then becomes, well, then how do we protect yourself from a market crash? And the first thing you want to look at is, well, how much risk are you taking? If the economy collapsed, how far down would we expect your portfolio to go? Now, we don't use terms like a conservative investor or aggressive or moderate, because what does that really mean, right? My conservative is very different than yours, and your aggressive could be very different than mine. So what we do is we use your maximum drawdown tolerance. What that effectively means is, in a severe economy, what is the lowest point that you're comfortable emotionally seeing your value go to, and what can your plan actually withstand? So for example, you say, Dave, I've got $1 million. I would never want to see it drop below $800,000. Then what we do, based off that 20% risk, we invest it intentionally and thoughtfully with different assets, so that when an economy crisis happens, it shouldn't drop more than that 20%, right? So investing in growth stocks is different than value stocks. In different market cycles, they're going to act differently, or perhaps dividend stocks. And then you could have, higher yielding bonds compared to treasury bonds, to mortgage real estate backed debt, that are also going to have different levels of volatility and act differently. And there's alternative investments too. So it's about being purposeful with the investments, and that they're not necessarily correlated. So different market cycles, these assets will act and behave a little bit differently. But far too often I see people tell me they're only comfortable with a 20 to 25% maximum drawdown, and we look at the analysis and they're at a 45 to 50%. So they're taking on almost or more than double the amount of risk than they're comfortable with, and they had no idea in the first place because no one helped them understand this concept. So first and foremost, we need to make sure that the level of risk is aligned with what you can emotionally withstand. And number two, the plan is developed around that and can also withstand it. So the first thing, one solution you could look at is having a cash buffer. Now, a cash buffer could mean literally you have money in cash. It could mean having money in really safe, like government type bonds. There are different ways of going about it. But the rule of thumb is if it takes 3 to 5 years for a very severe economy to fully go through the market cycle and recover, then you want to have 3 to 5 years of money that can float you through that time period. So if we're using the same example, we're taking $40,000 out of the market for our bills, then 4 years would be $160,000. A very safe thing to do and safeguard against market volatility is having 160 grand accessible. It could be diversified across, some government bonds, some cash, some CD, some different places that you could pull from to float you through those down years so you're not selling your stocks and assets at a loss. You can allow them to fully recover. We have another video on retirement income strategies. There's a few. One of them is called the surfing analogy. That's for aggressive investors. One of them is called the cruise analogy. One of my favorites. I also love cruises. For more moderate investors. And then there's the bottomless coffee approach, which is for more conservative investors. And each of these strategies both have their pros and cons with it. So outside of the cash buffer, and again, depending on your strategy, you could also look at bonds and dividend producing assets. When you are getting paid from a bond or a dividend, and for clarity, dividend is a company paying you a portion of their profits back as a dividend. A bond is debt. You're loaning a company money and they're paying you interest. So different forms of income. But in a severe economy, both of those can actually still pay you income, right? A bond will pay you income. And matter of fact, you could ladder it. So one bond matures in 1 year, the next in 5 years, the next in 10 years. And so that is called bond laddering. And so even in a severe economy, you'll still be getting that income. Very, very safe, depending on the bond, of course. And then a dividend stock. So very, financially big, strong companies that are paying you a dividend portion of their profits back to you. Even in a severe economy, they could absolutely still continue to pay you income. Now, could dividends get cut? Yes, absolutely. Could they get wiped away altogether? Yes, they could completely get wiped out altogether. This is not a bulletproof plan, but what it is it's setting you up for more success and more resilience because you still have income coming in. And for those of you, maybe you're using an income annuity to create guaranteed income, or you already have a pension, for example, guaranteed income in Social Security. If you have enough guaranteed income that covers your income need, well, then you don't have to worry about the market volatility, because if your portfolio is cut in half, you don't really need the money, so you can just let it recover. One of the things when it comes to generating income and being okay in a down economy is ideally if you can get your minimum dignity floor. Instead of have your dignity in retirement, you still need to pay your property tax and utilities and phone and put food on the table and lights and a phone bill, and some of you might even call Netflix a requirement. If you have enough guaranteed income to at least cover the basics, you can always change your discretionary spending. Maybe you don't take a lavish vacation, or you stop eating out at the 5-star restaurant, or whatever. You have more control over that. So these are the different safeguards that you can put in place to protect yourself from a market crash, because it can happen, it will happen, and you should be actually expecting a couple of them in your retirement. The question is, I guess what I would say is we can't control the economy. We don't know how bad it's going to get. We don't know what's going to cause the next big crash. The only thing that you can control is a thoughtful plan and decide which investments act in what ways in a down economy. Growth stocks are going to act, very differently than, just a strong blue chip dividend producing company in a down economy. There are different types of debt that you can be in. Some are more volatile, some are less volatile. So you can choose your exposure to the risk. and invest based on the maximum drawdown of risk that you're comfortable taking, so that number one, you're emotionally okay in a down economy, you can sleep at night. And number two, your plan is accounted for it. You've got safeguards and guardrails. And at the end of the day, these are not complex tactics. They're actually very simple. It doesn't take rocket science to safeguard your retirement plan. It just takes a very thoughtful approach and being very intentional with where you put your money. What is the purpose of the money being put there? What's the objective? Giving it purpose and being okay with that. And that effectively will build a resilient plan so that when the market does crash, you know what to expect, you have your safeguards in place, and you can keep thriving and enjoying your retirement.